Hi everybody, this is Bill Neville and I'm going to be doing the presentation today. So we're going to talk about, we're titling this Invest Like a Venture Capitalist, which is going to focus on investing in private placements. And before I get started, I'm going to put this up here and read this to you. The Entrust Group does not provide investment advice or endorse any products. All information materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So bear in mind that Entrust, we are administrators and record keepers for self-directed retirement accounts. I am not a CPA nor an attorney, and we don't have anybody in our company who is a CPA nor an attorney. So everything that I'm going to be presenting here today is just for educational purposes, and I'm going to try and be as clear on this topic, as educated on this topic, but this is a very complicated topic. So if you might end up having questions that I'm not entirely sure I'm going to be able to answer, I might refer you to go speak to an attorney who would have better knowledge about this. Also, if you do have questions, I'm going to take them at the end to go ahead and type them into the message box, and then at the end I'm going to go through each question and answer them. So if it's specifically about private placements or about self-directed IRAs in general, go ahead and type that in there and I'll get to it at the end. So what we're going to talk about, what is a private placement, some history associated with them, what are different private placement investment options, what's an offering memorandum, and doing your due diligence. We're going to go over prohibited transactions and disqualified persons. This is always important with self-directed IRAs, but it's particularly important when you're talking about private equity. And then we're going to do a case study, how to invest in private placements, and specifically we're going to be talking about how to invest through Title III of the Jobs Act that specifically dealt with using your IRA or being able to invest in private placements through crowdfunding portals. A little bit about Entrust. We administer self-directed retirement accounts. So what that means is that we provide the administrative and custodial services for retirement accounts that allow you to invest in alternative assets. And an alternative asset is anything other than a publicly traded stock, bond, or mutual fund, or CDs. So real estate, precious metals, private placements, promissory notes, trust deeds, tax liens. We had somebody invest in a racehorse one time in a bowling alley. I mean, pretty much anything you can think of, almost anything you're allowed to invest inside your retirement account. You need a company who's willing to hold those assets, which traditional brokerage firms are not typically willing to do. Traditional brokerage firms are only willing to hold publicly traded stock, bonds, mutual funds, and CDs. So that's what the self-directed IRA industry is that you take your existing retirement account, be it a Roth or a traditional SEP, 401k, whatever it is, and you make all your own investment decisions and you can hold alternative assets. And again, an alternative asset, it's any asset other than a publicly traded stock, bond, or mutual fund. We have been in business now since 1981, so over 36 years. And we do quite a number of transactions every month and currently hold somewhere slightly over about $3 billion in investor assets. The majority of our staff, including myself, are certified IRA service professionals. We are the leading educator in our industry. We're the only company that has a national continuing education program for realtors and CPAs that provides 2 CE credits, I think, for a class that we give. We do lots of national and local events and webinars, which is what you're currently seeing here. We also do private webinars. If somebody wants to bring a group in and have us do a webinar, we do that. And we also have what's called an IRA Academy, where one of the persons from our company actually will do a class for other competitors of ours in our industry so that they can get educated and pass the certified IRA, the CISP, certified IRA service professionals themselves. We're the ones that teaches the class to our competitors so that they can help pass that test. All right, what is a private placement? In a very global sense, a very general sense, a private placement is simply equities that are not publicly traded, right? So when people typically invest in companies, they do it through the stock exchange, the New York Stock Exchange, AMEX, where you buy publicly traded stocks or mutual funds that can be a package of different stocks and bonds bundled together. Private placements, which makes up a large majority of the companies, well, a lot of companies, when they raise funding, they will sell their shares of their company before they go public, and that's what's called a private placement. Typically, securities that are private are not required to be registered with the Securities and Exchange Commission. So whenever somebody is publicly selling their shares of their company through the exchange, there is requirements associated with the SEC that need to be filed. With private placements, that is typically not the case. As I mentioned earlier, that's how a lot of companies are raising capital. Before they get to the point with startups, before they get to the point where they're going to venture capitalists and raising huge amounts of money, a lot of times, like as an example, Uber. To give a basic example, they now, you might read in the paper about, where they've raised another $100 million. They're raising them from venture capitalists. And so that is sort of past the point that we're going to be talking about here, which is the early stage where they're raising startups startups are raising money at the very early stages through bringing in investors that can be accredited and non-accredited investors. And as we mentioned there, the next bullet point, typically only available to institutional investors and accredited investors. The Jobs Act changed that and allowed more unaccredited investors, non-accredited investors to invest in private placements. For your information, what is an accredited investor? An accredited investor is someone who either has made income of $200,000 or more, and if you're a couple, if you're a married couple, $300,000 or more in each of the last 2 years, and has a reasonable expectation to make that amount this year, or has a net worth not including your primary residence of $1 million, over $1 million. Okay? So if you fall under that, you're an accredited investor, and you're going to find a lot more opportunities to invest in private placements being an accredited investor than non-accredited investors will. But again, the Jobs Act changed that. And I'm going to get into a little more detail with that a little bit. And there's different types of private placements, and again, that there's different the different regulations that allows for accredited and non-accredited investors to invest in private placements. And again, another bullet point, I'm going to talk a little bit more detail about that. Private placements, so startups, typically your potential for higher returns, but also there's probably a greater risk that you're going to lose your money, right? So there are a lot of startups, a lot of companies that start up and really don't get anywhere and then they fail. And then there are the startups that become Facebook and Google and make the original investors very, very wealthy people. And again, the Jobs Act has allowed for more non-accredited investors to be able to get into those types of investments. But the risk is much higher. It's a basic risk-return ratio. The higher risk, the higher rate of return you typically are allowing for yourself. Private placements, again, they're not publicly traded, right? If you buy stock in a publicly traded company, you buy stock in Amazon, and it's traded on the stock exchange, it's easy to buy and sell because there's always buyers and sellers that are looking for that on the stock exchange, and then a number of buyers compared to the number of sellers is going to affect the share price. Private placements are not necessarily going to be easy to sell or liquidate. So if you're thinking about investing in a private placement, if you know somebody who's got a private company is looking for investors, bear in mind that that's not a liquid investment. There's going to be driven by how well the company does, and hopefully at some point it goes public and then it becomes much more liquid. For the issuers, for the companies that are looking to raise funding, selling to self-directed IRAs can often be a much faster process for them to raise funding than going through a traditional loan process to borrow money. And a lot of this material, a lot of the stuff that I'm talking about and what I use to educate myself comes from that link that we have there, the Securities and Exchange Commission educational material about private placements and things to and that link specifically is much more about Regulation D, Reg D under the ability to issue private placements. Not so much about the Jobs Act, which is what we're going to talk a little bit about more, particularly when we get to the case study. And here we're to that, Regulation D in the Jobs Act. So Reg D is a Securities and Exchange Commission regulation governing private placement exemptions that allows you to raise capital through selling equity or debt securities without having to register the securities with the SEC, and ability to gain funding without having to go through a public offering. So I'm going to talk a little bit about Reg D, and if you'll excuse me, I'm going to be reading a little bit from a document that I have here. But there's three specific what they call rules, SEC rules under Reg D. There's Rule 504, 505, and 506 that governs how issuers can raise funding through a Reg D offering. And essentially what that says, if they issue it, if they're raising funding through Rule 504, it allows issuers to offer and sell up to $1 million of securities in any 12-month period to any type of investor. So whether it's accredited or non-accredited, doesn't matter. They can issue shares and raise up to $1 million every 12 months to both accredited and non-accredited investors. And this is a very general overview, by the way. This gets very complicated and much more detailed. So, and again, I'm not an expert on this field, but I'm going to give a general overview so that people can understand some of this stuff. So that's Rule 504. Under Rule 505, issuers can offer and sell up to $5 million. They can raise $5 million of capital in any 12-month period. However, it limits the type of investors who may purchase the securities. So they can sell to any unlimited number of accredited investors. Again, accredited investors, $200,000 of income, 2 years plus expectation this year, or $1 million in net worth excluding their primary residence. So any number of accredited investors, but no more than 35 non-accredited investors. Okay, and then in Rule 506 has the same 35 non-accredited investors, unlimited accredited investors, but the non-accredited investors must be, in the words the SEC uses, is financially sophisticated. In other words, they must have sufficient knowledge and experience in financial and business matters to evaluate the investment. All right, so that's a Reg D offering, 504, 505, and 506, that allows someone, they don't have to go through a crowdfunding portal. They can raise money by issuing shares and selling shares in the company to both accredited and non-accredited investors of $1 million or $5 million, and to both accredited and non-accredited investors. All right. Now the Jobs Act, which came out in 2012, this is called Jumpstart Our Business Startups, and also known as the Crowdfunding Act. So what this has done is, and there's one specific title, which is Title III of the Jobs Act, which specifically deals with raising money through crowdfunding portals. Right? So they can go to, there are a lot of these portals out there, and the portals, by the way, have to be registered with the SEC. So although the issuance doesn't have to be, and I want to go back to the Reg D thing. So there is what's called a Form D that the issuer, that if they're going to file under Regulation D, they have to file what's called a Form D to issue. With the Jobs Act and Title III of the Jobs Act that allows companies to raise money through crowdfunding portals, it allows for any number of non-accredited investors to be able to invest, but it does limit the dollar amount that each non-accredited investor can invest through that portal. And I'm gonna get to that in a little bit in terms of what the dollar amount is. Jobs Act was kind of widely hailed at the time as a rare in these days instance of both sides of government coming together to put an act in place that doesn't really appear to be any downside to it. There's benefits across the board in terms of startups and small businesses being able to raise funding, and non-accredited investors and non-institutional investors to be able to invest. A lot of times what it's been is that in investing in these small companies has been hedge funds and institutional investors, and obviously the people who already have a lot of money, the accredited investors, to put money into these companies. And the Jobs Act has allowed the average individual, the average person, to be able to invest in startup companies. But they have to be done through crowdfunding portals, right? So these companies, that's Title III is associated with that. FINRA oversees this, and I'm going to read from a thing I printed out here. It says the Jobs Act established crowdfunding provisions that allow early-stage businesses to offer and sell securities, and provided that crowdfunding dollar limits be adjusted for inflation every 5 years. So they recently, in 2017, this year, adjusted the amount that can be invested through a crowdfunding portal. And the role of FINRA, Financial Industry Regulatory Authority, is to oversee the registration of crowdfunding portals and to ensure that they comply with the federal securities laws and FINRA rules. So there is oversight associated with this, and again, the portals themselves have to register with the SEC. All right, let me get to the next screen here. So when we're talking about private placements, and we're talking about shares in startups and private companies, but they're also, in a global sense, private placements is, as I mentioned earlier, it's any investment shares that are not publicly traded. So they could be, we'd mentioned crowdfunding, but they could be notes. They could be limited liability corporations, like LLCs, limited partnerships, C corporations, private stock, and partnerships all fall under the global term from our standpoint of private placement. So a syndication, for example, somebody might create an LLC where they've created a syndication and they're bringing in investors to invest in the LLC, and that LLC is then going to turn around and invest, let's say, in an apartment building or something like that. I have referral partners who operate that way. In a very global sense, those are considered private placements, right? But we're going to be specifically talking about, when I get a little further here, investing through crowdfunding portals via the Jobs Act. So when investing in a private placement, you should receive what's known as a private placement memorandum, a PPM, which is a legal document. It lays out objectives, risks and terms of investment, et cetera, et cetera. If you're looking to invest in a private placement, make sure that you get a PPM. It's basically a thorough business plan. It should be part of the due diligence that you do. If you have any financial advisors who are recommending, and by the way, if financial advisors are recommending you invest in a private placement, that financial advisor has certain requirements and responsibilities in terms of doing his own due diligence before he can recommend a private placement. And it's essentially one of the reasons why Entrust we don't do that. We're not financial advisors. We don't recommend any particular investment. If you're working through a financial advisor, they are required to do certain due diligence on that. All right? Make sure you get a look at the PPM. And here we get into a little bit of the due diligence. Beware of, like, if there's any promises of high returns, and that's a general thing that should be applied of any investment that you're going to make, is be very careful of that if they're promising a high return. It's very difficult to guarantee a high return, so be really careful when you see that in any type of investment that you do. Do background check of the make sure that the financial advisor, if it's coming through a broker or financial advisor, as well as the principals of the company, make sure you get copies of all written materials. And I'm going to go back to, let me find my document. When it talks about the Reg D offering and Rule 506, and it specifically says on there, as with the Rule 505 authoring, if non-accredited investors are involved, the issuer must disclose certain information about itself, including its financial statements. If selling only to accredited investors, the issuer has discretion as to what to disclose to investors. Any information provided to accredited investors must be provided to non-accredited investors. So make sure that you get things in writing. They're required to give you information so that you can do your due diligence. Also, again, we talked about these are typically illiquid assets. So if liquidity, if the ability to cash out is of concern of yours, make sure that you have your ducks lined up for that eventuality, that you have a way to liquidate if that's a concern of yours. Research if there's any kind of ability to opt out or return your shares after any particular amount of time. Check out the private placement memorandum, and as always, consult with a financial and legal advisor. I'm also going to read to you 4 tips that we don't have on here that in the FINRA document that I printed out. Says, while investing in early stage businesses may bring rewards, it also carries risks. These tips can help determine if a crowdfunding offering is right for you. Again, this is specific to crowdfunding, but can be used for any private placement type thing. Read and understand the educational and financial information and all disclosures provided by the issuer and crowdfunding intermediaries, right? So that was one of the things that we talked about there. Ask yourself if you can handle the risk and the potential loss of your investment. Any investment that you do, be aware that you could lose money, right? That the investment that you make could go belly up. So that risk, it tends to be greater in private placement. So just, make sure that if it's in money that you're investing, that it's money that you can afford to lose. Recognize that fraud is a possibility. So when you're getting into private placements, that as opposed to publicly traded stock bonds and mutual funds, you don't as often see an Enron type situation where something that's publicly traded and it turns out to be, to a large extent, a large Ponzi scheme almost. You're not going to see that so much in publicly traded. The risk with private placements becomes much greater from that standpoint. And then, make sure you have clear prioritized goals, right? And they said revisit your financial goals, setting clear prioritized goals, each with steps to achieve the goal, price tag, and the time frame will help guide your investment approach, including whether crowdfunding offerings have a place in your portfolio. So that's a general thing, but it's certainly something that I wanted to emphasize here. If you're looking to do this type of investment, gauge your risk. If you're looking to do any type of investment, gauge your risk, because these tend to be it's high risk, high reward. If you can stumble upon the next Google or Facebook, then you're going to make your IRA a lot of money, but be aware that those tend to be fewer and far between. As always, with any transaction you do in an IRA, there are such things called a prohibited transaction, which is the improper use of an IRA account by any disqualified persons. The investments in an IRA are intended to benefit the IRA only and not the IRA holder. So what that means in this example, if you use your IRA to invest in a private placement and that private placement makes a lot of money, the IRA receives the dividend, receives the benefit of that, not you as an individual. You do indirectly in that you grew your retirement account, and now hopefully your account's worth a lot of money and it enables you to retire earlier. But they can't, the issuer or the company that you invest in, if they're paying a dividend or if it pays out, the payment has to go back to your retirement account. It doesn't go to you personally. So here's a list of disqualified persons. You, your spouse, you as the account holder, your spouse, your ancestors, your lineal descendants, spouses of your lineal descendants, and then any fiduciaries. So what does that mean? If your child is starting a company and you want to use your IRA to invest in a company, it's probably not going to be allowed because your child is a disqualified person and your IRA is not allowed to invest in a company of a disqualified person. Now, there is this thing called ROBS, which is rollover for business startups, which the IRS has in place that allows for people to use their retirement accounts to fund their own startup business. Again, ROBS, rollover for business startups. And it's just simply, it's not any particular program so much as it is that they've written this in that says if you want to use your retirement account to help fund and finance your own business, your startup business, you are allowed to do that. But there's very specific ways that it has to be done. First of all, the company has to be structured as a C corporation. That's one of the main things associated with it. There is a company that I work with that can help people structure their company and do it the right way so that they fall under the guidelines of the ROBs that the IRS has in place. So just bear in mind that there is potential, there is a possibility that you can use your retirement account to help fund your own startup business, but it has to be structured in a very specific way to meet this ROBs requirement. And if it's something you're looking to do, reach out to me, and I can put you in contact with the people that I refer to that will help you with that process. So prohibited transaction, again, it essentially says your IRA doing business with a disqualified person. So for example, your IRA can't borrow money or loan to a disqualified person. You can't sell a property to a disqualified person. You can't use your IRA as collateral or security for you personally to borrow money. These are just some examples. Buying a property for personal use. So this is very real estate specific. What we're talking about with companies, if you have your own business, your IRA can't loan your business money, right? That would be an example of this situation. Your IRA can't loan to your parents' business. Your parents can't loan to your business, right? There's disqualified persons. There are certain rules associated with that. And this is where we get into the section 4975 of the Internal Revenue Code is what is dealing with prohibited transactions and disqualified person. And it gets very gray when you're getting into private ownership, but essentially for all intents and purposes, if you own more than 50%, if you are a passive investor in a company and you own greater than 50% of that company, then your IRA is not allowed to invest in that company, right? But the ROBs that I talked about, rollover for business startups, that kind of contradicts that a little bit. So, but again, that has to be structured in a certain way. In general, if your IRA or a disqualified person owns 50% of a business, your IRA is not allowed to invest in that business. If you are a part of the company, right? So let's say you are at some level, you're part of the company that you receive some kind of salary, then that goes down to 10%. Your IRAs, if you own more than 10% and you are also part of the company, the 50% is if you're a passive investor. If you're part of the company, you own 10% or more of the business, then your IRA is not allowed to invest. If you're an officer in the company, then your IRA is not allowed to invest at all. All right? That's essentially what the Section 4975 of the Internal Revenue Code reads when it comes to using your IRA to invest in private companies. So here's a case study, and again, this is specific to Title III of the Jobs Act, where it talks about being able to, for non-accredited investors, to be able to invest. So in this case, we're using John Wood. His annual income is $150,000. He has net worth of less than $1 million, not counting his home. So he is considered a non-accredited investor. So he's looking to invest part of his retirement funds in a startup that is raising funding through a crowdfunding portal. So he opens an account with Entrust. So the name of his account for investment purposes will be the Entrust Group for benefit of. That's what FBO stands for. The Entrust Group, FBO, John Wood, IRA number, whatever his account number ends up being. He rolls over $40,000 from an old 401k that he used to work with. And so based on Title III, John is able to invest up to $15,000, 10% of his annual income in a startup. And there's a little bullet point investment limited depending on one's net worth and annual income. So let's talk about that. How much can someone invest during any 12-month period? Again, so this would be, he could invest $15,000 this year and another $15,000  12 months from now. So the rules state that if either your annual income or your net worth is less than $107,000, then during any 12-month period you can invest up to the greater of either $2,200 or 5% of the lesser of your annual income or net worth. Okay, so let's say in this particular instance, to give an example, let's say, all right, so if your net worth is less than $107,000, so let's say his earned income is $100,000 and his net worth is also, and let's say his net worth is $150,000, the greater of either $2,200 or 5% of the lesser of your annual income or net worth. So in this case, his net worth, if it was 150 and his income is 100, he could invest 5% of the lesser, which $100,000 in that case would be $5,000. Now in this case, he makes more than $107,000, so he can invest up to 10% of his annual income or net worth, whichever is less, not to exceed $107,000. So in this example, we're assuming that his net worth is greater than his income of $150,000. I realize that that may really be confusing, but essentially, if you make more than $107,000 and your income is more than $107,000, then you can invest 10% of your income. If you're over $200,000, you become an accredited investor, and that's a whole new different ballgame. This is for non-accredited investors. If you make less than $107,000, then you can invest up to 5% of your income. The greater of either $2,200. So let's say you make $20,000 as an example, and you want to invest. You can invest $2,200 because that's the minimum that you're allowed to invest. I hope everybody followed that. So John, he does his due diligence. He gets his written materials, the offering memorandum. He does the research, investigates the risk. He's comfortable with the risk. He looks for the private placement memorandum. Does his research on the liquidity, and if he wants to return the shares, meets the people in person, does everything that he wants to do, and ensures that the transaction does not involve any disqualified person. So the company isn't owned by his parents or children or anything like that. And pulls the trigger, decides he wants to do the investment. So he would provide to us a subscription agreement. So there would be an agreement between him and his IRA and the investment in the name of his IRA. So the investor would be the Entrust Group for benefit of John Wood, IRA number, whatever his account number ends up being. Sends that to us. We review and sign off on the agreement, on the purchase agreement. We send the $20,000 actually through the portal. Would go, so the broker in this case would be the portal. The $20K goes to the company, and now his IRA owns $20,000 worth of that company. And hopefully it grows to be worth millions of dollars. So to summarize, you have potential higher returns whenever you're dealing with private placements. And through the Jobs Act, non-accredited investors can now invest in private placements, but they're risky. So bear in mind, I mean, all investments have some amount of risk in it. These tend to be a little bit riskier, but they also do have potential for a much greater return. It provides more diversity of investment options instead of being just limited to the publicly traded stocks, bonds, mutual funds. And make sure you don't do any prohibited transactions. And the due diligence is incumbent upon you. We don't help you find the investment, and we don't do any due diligence or research on the investment. You instruct us to invest, and we'll process the investment on behalf of your IRA. All right, so let's get to some questions here. First question, the California cannabis industry is projected to be a $7 billion market. Our firm has several clients in the industry. Is there any firms Entrust can refer us to? Yeah, there isn't. We don't really do that. Sorry, Ray. We don't really refer people to other people from that standpoint. Yeah, I don't really have an answer to that other than no, we don't have anybody we can refer you to. How would I know if Reg D offering is satisfying the rules? Talk to a lawyer. Make sure you have somebody who's familiar with how to issue shares through a Reg D offering, and have them review all the documents and that you follow. I mean, ultimately, that's the best way, is have somebody legal to take a look at it. Next question: do private placements outside the United States qualify? Sure. When you're looking to invest, so that's a good question. So you can certainly invest in companies outside the United States. How those fall under like these different offerings, I actually don't know the answer to that. I mean, if you're asking us, can you use your IRA to invest in a company outside the United States, as long as the company itself is willing to accept an IRA as an investor, then we'll process that investment. We'll need we'll need some kind of subscription agreement. We'll need a purchase agreement to work off of, and these companies outside the United States, they don't necessarily fall under the requirements and the different regulations in the United States. So talking about private placements being risky, I would say that gets even more risky. But in terms of will we process an investment for a company that's outside the United States? Absolutely, we have done that. Again, we're not doing the research to make sure that the company is following the regulations as far as issuing to you, right? If you send us a purchase agreement, it's properly vested in the name of the IRA, and there's no obvious prohibited transactions, we're going to process that transaction. It's incumbent upon you and your financial advisor to do the due diligence. It's incumbent upon the issuer, the company that's raising funding, to follow the rules that they're required to follow. And if they don't, and it ends up that something that you purchase an investment that turns out to have been done outside the rules or wasn't allowed to be done that way, then you're going to lose your money, right? That the IRA is going to lose that money. So you need to make sure that you check and that they're doing everything above board and are following the rules that they're supposed to follow. Can an unaccredited investor use a self-directed IRA to invest in a Reg D 506B? All right, so I had a feeling I was going to get questions like these that would get really into the weeds as far as, I don't know Reg D 506B specifically, but I'm going to answer it the same way I answered the last question. If we get a purchase agreement that's properly vested in the name of the IRA, and you sign off on it, and you fill out our bidirection form and instruct us to make that investment, as long as it's not a prohibited transaction, which means as long as it's not obviously, you're not investing in your own company or investing in your kid's company or your parents' company or something like that, where it would be considered a prohibited transaction, we're going to process the investment. Can an unaccredited investor use a self-directed to investor? If an unaccredited investor can invest through Regulation 506B, then an unaccredited investor can use their IRA to invest through Reg D 506B. And that's a good question. That brings up something that I didn't mention, that one of the rules that went into place. In order for your IRA to be considered an accredited investor, you personally have to be considered an accredited investor. Right? So if the company or the syndication or even the crowdfunding portal is only accepting accredited investors and you want to use your IRA, you have to qualify as an accredited investor. Right? You have to have the $200,000 worth of income for the last 2 years, or you have to have the $1 million net worth, not counting your home. If I start an LLC to buy a property, is that considered a private placement if I'm trying to buy it with my self-directed? So again, in a very global sense, an LLC, in that case, we would globally consider that LLC to be, from our standpoint of how we count investments within our system, we would consider that to be a private placement. Now, is that something that falls under like Reg D or Title III of the Jobs Act? No, I don't think it does, right? But that's a conversation to have with a lawyer in terms of what you need to file, what documents you need to put together in order to create that LLC. I mean, if you're talking about, sorry, I just lost my screen. I'm trying to buy it with myself. If you're, and as I'm rereading your question, if you're talking about creating an LLC, a single-member LLC, where your IRA is the single-member I was looking at, when you said that, I was looking at you were starting a syndication. If you're just saying, I'm going to start an LLC, fund it with my IRA, and use that as a pass-through entity so that you can get checkbook control to buy whatever you want to invest in through the LLC, then no, we don't consider that a private placement. When we're talking about private placement, we're talking about companies or syndications, LLCs, that are raising funding through multiple investors. What are the costs? If you're talking about Entrust costs, please go to our website, theentrustgroup.com. We have our fee disclosure is listed on that form, or let me go to the next screen here, or email me. There's my email address, and I will email you our fee disclosure form. Where to go for the guidelines for unaccredited investors? I mean, Google. That's what I did. I mean, you Google private placements, you're going to see a whole bunch of stuff. Google Jobs Act, Google Reg D. You know, just there's a ton of information out there. You can. It's not hard to find, but you're going to have to go look for it a little bit. The link that we provided, and I can, if anybody wants that link, go ahead and let us know. We're going to ask for your feedback at the end of this. You're going to get a thing that asks for feedback. Ask for that link. Our marketing team will send it to you. That's a good place to start. FINRA and the SEC, the IRS. I mean, there's a lot of information out there. Question is, join IRA with an LLC. Can you partner your IRA with an LLC? The answer to that is yes. I'm not sure if that's the question, but you can partner your IRA with an LLC to make an investment if that's something you want to do. Next question, I wish to set up an LLC that builds car washes. Can you provide an example of a sample plan that provides investors a return or percentage of the investment? No. Was typical, or is there one? That's not what we do. Sorry. We're providing administrative and custodial services for self-directed retirement accounts. We don't provide sample plans. And then you followed up with this LLC would also own the land on which the car wash is to be built. Yeah, I mean I don't help you put together a plan. So that's actually the last question I got, was that last one. So you know, normally when I do these, I get you know, like 100 questions. I get that this is a pretty complicated topic, like I said, and we gave a kind of an overview. And the overriding point to this is that you can use your IRA to invest in private placements. If you're not a accredited investor, the Jobs Act allows a greater ability to be able to do that. But even prior to the Jobs Act, through Reg D, issuers could raise money from non-accredited investors, but it depended upon how they file that issuing, and it limited the number of non-accredited investors that they could raise money from. So you know, if you've got friends or family that are looking to raise funding through some kind of business or startup, you know, you can use your IRA to do that, whether you're accredited or non-accredited investor. And at this point, that actually looks like I'm not getting any more questions. So I want to thank you all for joining us. And again, if there's any additional information that you want, you can feel free to email me, or whenever you give the feedback at the end of this, go ahead and put your question there, and marketing will either forward it to me or they'll provide the information to you that you're looking for. Again, thanks everybody for joining us, and have a great afternoon.